What stood out to you so far in 2025?
Been a very strong year for especially hard assets, and China. Gold is leading the pack, up 40% year to date.
When we look at the U.S., it's been a noisy couple of months, particularly as it relates to the labor market and inflation. We've seen kind of both those numbers moving in the opposite direction that we would like to see them. It's bringing up some question marks about where we are in this sort of cycle and where we are in the economy.
Last month, we saw big sales from old wallets, but Bitcoin prices are not crashing. They are going down, of course, but it's not a crash. I mean, it's $10,000 from the all-time highs.
Hello, everyone, and welcome to the latest investment outlook brought to you by eToro for quarter four of 2025. And what a year it has been. Our title for today, Late Cycle Strength, Riding the Rally and Hedging the Risks. As always, do take a moment just to have a quick look over the disclaimer, and remember it is a marketing communication and should not be taken as investment advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. Today we're joined by the dream team: Lale Akana, our global market analyst; Brett Kenwell, our US investment analyst; and Javier Molina, our Spanish analyst and crypto expert. For those watching on YouTube, remember the link is in the bio. The team are all waving at you. They can't wait to get involved and be quizzed on what happened in the last 3 months and what could happen in the next 3 months, the last three of the year. So let's get into it. Lale, the first question is to you. What stood out to you so far in 2025?
Thank you, Sam. Look, it's been a very strong year for especially hard assets and China. When we look at year-to-date performance as of end of September, gold is leading the pack, up 40% year-to-date, really benefiting from safe haven demand, but also, most importantly, central bank buying. MSCI China has rallied 36%. It does suggest policy support and hopes for domestic recovery priced into the market. Bitcoin is also having a standout year, up 23%, while the big US tech names, the so-called Mag 7, have delivered an 18% gain. Index-wise, NASDAQ is strong, so is S&P 500, which is up by 13%, really showing us, Sam, that US equities have kept momentum, though with more modest breadth. On the other side, not everything has been positive. US real estate has been flat. Private equity is down by 2%, and the US dollar is down by 11% this year, really reflecting to us that the shift in rate expectations and capital flows are out of the US. And the currency weakness has in turn supported both commodities and non-US equity markets. Looking forward, there are key things that we will be watching in the last quarter of this year. Obviously, earnings season is very important. It will be kicking off on October 14th with the US banks. Central banks will be in focus. We all know that the Fed's starting its cutting cycle. The next meeting is on October 29th and on December 10th, while the ECB will be on October 30th and December 18th. In early November, we will get results from Apple, Amazon, Alphabet, obviously key indicators for tech sentiment that we will be eyeing carefully. And finally, in mid-December, we will see Q4 earnings announcements, which will give us an early steer on 2026 expectations. So overall, Sam, we think that while 2025 has already delivered strong gains, the last quarter, in our opinion, is packed with events that could really set the tone for markets close to the year and also for 2026.
Yeah, bring it on. It's incredible looking at that. I mean, gold 40%. What an incredible run it has been on. Even 23% for Bitcoin isn't bad at all. But yeah, as we mentioned there, the dollar coming under a bit of pressure. But the next 3 months will be interesting as always. And focusing on that 3 months, Lale, what are some of the key drivers you've got your eyes on?
Yeah, a lot to talk about here. Look, the first thing that we look at is earnings guidance and margins. They remain front and center for us as retail investors. Operating margins for the S&P 500 are back at all-time highs, right? Even after what we saw with trade uncertainty in the second quarter of this year. But what is important for us is the fact that the market performance is broadening beyond the Max 7, right? So now we're seeing actually strong performance coming from financials, from industrials, and from consumer discretionary sector, especially contributing meaningfully to profit. So for the fourth quarter, Sam, we will be watching whether companies can defend margins against, still lingering cost pressures and tariff-related volatility. So in our opinion, guidance updates will likely dictate leadership into 2026. The second thing that we will be watching would be policy uncertainty as it relates to tariffs and trade policy overall. Again, we think that companies have so far managed to absorb trade-related cost pressures, but that resilience could be tested if volatility persists. And obviously, we're taking a look at any escalation in US-China or even India tensions that could potentially spill into supply chains, driving macro decoupling and also investor hedging. The third factor that we will take a look at is monetary policy divergence. As I've said before, the Fed has just started its cutting cycle, while the ECB and Bank of England are at the moment they're pausing. Obviously, this divergence matters most for currencies. Recall that the US dollar is already down double digits this year, which has really supported non-US equities so far. And it's also been a tailwind for gold, which is, as we know, trading at record levels in real terms at the moment. But we want to see whether inflation expectations remain anchored, whether the Fed's cutting cycle will continue, and how that will impact markets overall. The fourth factor is tech and AI. Obviously, they remain powerful, but they are becoming more nuanced drivers in terms of market performance. AI is part of a long technological revolution, in our opinion, as we move from more the infrastructure build out of large language models toward the more agentic productivity for years ahead. So in our opinion, that means that actually opportunities are broadening beyond mega cap hyperscalers, but now creating space for equities in sectors such as industrials, utilities, and semis that are tied to data demand. And the last one is crypto tailwinds and regulation. Bitcoin has had double digits year to date. And the good thing that we are seeing at the moment is obviously institutional adoption is deepening. But now we feel like the market is actually waiting for regulatory clarity, right? So new product launches and frameworks could reinforce legitimacy. But again, we need more regulatory clarity coming in the next few quarters, which we think will provide more tailwind for crypto overall. So overall, just to sum up, Sam, margins and guidance are critical. Tariffs and trade policy are a risk lever. Monetary divergence is key for reshaping FX and liquidity. AI continues to evolve, but with slowing capex intensity. And finally, crypto is still riding a structural wave pending regulatory clarity at the moment.
Thank you, Lale. And we'll come back to you very shortly. And I just wanted to give a shout out for anyone that is listening on the podcast, wherever you are, at home or on the beach. If you want to follow along on YouTube, the link is in the bio. And it'd be great to hear from you about what you are really focusing on for the next 3 months and even the next year as well. On the shared screen at the moment, we've got the online survey results. I love hearing from people about their views quarter on quarter. You can see the asset class that they expect to perform best in the next 3 months. You can see there's an increase from that June poll quite significantly for stocks. It's gone to 55% from 49%. Crypto is up as well. Commodities down a touch, actually. I mean, gold has obviously performed quite well, but oil, not so much, still below some key technical levels. In terms of the region, US is a clear sort of winner there, 60% from 41%. Europe has come down a touch as well, and disruptive tech really the theme that is expected to perform best in the last 3 months of the year. And when we look at sector, no surprise to see tech up there from 57% up to 75%. Now, let's move over to the US and to my second favorite American behind, Bryson DeChambeau. And that is a compliment, Brett, for you. But how are you seeing things at the moment? The Fed have obviously just restarted the cutting cycle. What are your thoughts on this and everything else?
Yeah, Sam, thanks. I'm glad to be on the podium at least with Bryce. When we look at the U.S., it's been a noisy couple of months as it relates to, particularly as it relates to the labor market and inflation. We've seen kind of both those numbers moving in the opposite direction that we would like to see them. We want to see inflation move lower. It's been ticking higher. We want to see employment moving higher. That's been ticking lower. It's bringing up some question marks about where we are in this sort of cycle and where we are in the economy. And it's really kind of forced the Fed to step in and make some decisions too. They just cut interest rates for the first time this year. Markets expect them to do 2 more cuts through the remainder of the year. As Lale pointed out a few slides ago, they have 2 more meetings this year. We'll kind of see how, excuse me, we'll kind of see how that evolves in terms of rate cut expectations for the remainder of this year and as we look into 2026. But I think, these last couple months have been kind of noisy. This whole year has been pretty noisy when it relates to, especially with the U.S. stock market. We came in on the highs. We had that really, really fast decline in late Q1, early Q2, and then it's been kind of off to the races since. We've had this sort of lockout rally where if you missed it, it was hard to get back in. When we have markets like that, I think it's really important to kind of go back to the basics and remember what's the main catalyst, what's the driver for these types of moves and for the market overall. And the answer to that is earnings. And if you look at the chart, I think does a pretty good job illustrating expectations for the next 12 months and for the next 24 months. Those expectations continue to go higher. So it's not as if markets are rallying on nothing. There's the expectations for profits to be there. And, we get earnings season starts in a couple of weeks. We're going to get a really good indication of what the banks are seeing, how big tech's looking. We're going to really get some fundamental data that we need to really process expectations for 2026. But at the end of the day, a strong consumer helps power a strong economy, and that is a big driver for corporate earnings. And if you jump to the next slide, we can kind of dive in a little bit deeper. In this case, it's small caps. The small caps have gotten a lot of attention lately, and some people may not realize that the index is up. The Russell 2000, which is a gauge of small cap stocks, it's up about 40% from the April lows. That's outpacing the S&P 500, and in some cases, in some ways, doesn't feel like it's getting the recognition it deserves. It's maybe a little bit hard to say that with it hitting all-time highs, but at the same time, we're back to the same level we were in late 2021, which was the gasping breaths of the last bull market. So, small caps are kind of a unique position here. On the one hand, they do benefit from rate cuts. It's a positive, it expands margins. It's good for cash flows. And there's this expectation that they will do well in 2026. When we look at, for instance, earnings expectations over the next 12 months, analysts expect about 23% growth out of these firms. That's almost triple the S&P 500. So it's actually pretty notable. But small caps have been a really tough trade to nail down, and I say this admittedly myself. I've had higher expectations for small caps over the last several years to sort of jump in on this bull market. I think people forget that small caps tend to lead the early innings of a bull market, and we didn't really see that this time around over these last few years. It was really mega cap tech sort of took that baton and ran with it, and we have really been waiting to see small caps really get in on the game in a sustainable way. We've had these nice rallies, but they tend to fizzle out and really in this kind of 2,400 to 2,500 area on the Russell. We'll see if in Q4, I think will be a really good indicator of whether we're kind of breaking out of this range or if we're going to see a little bit more of the same and leave more question marks for 2026. So small caps are something that's certainly on my radar over the next few months and as we go into year end.
Thank you very much, Brett. And a key massive technical level for those watching on YouTube, you'll be able to see that as well. The next time we record this in 3 months' time, we'll know whether the Fed did cut another 2 times. But I want to ask people at home, do you think they will? At the moment, it's mid 90%. At the time of recording that, they're going to cut in October. But I want to know, does anyone think they won't? And let us know why. While you all do that, we're going to move over to Europe. Lale, there's been leadership reshuffles and all of that. How are you seeing it?
Yes, again, I mean, quite interesting leadership reshuffle since the start of 2025. Look, the region has been investor friendly, really, in our opinion, supported by a accommodative policy, both on the fiscal but also on the monetary side. Again, attractive relative valuations compared to the United States, and obviously capital inflows seeking diversification are headed towards the region, right? But in our opinion, sentiment is still clouded by tariff pressures and ongoing softness in technology. The standout this year has been Southern Europe. Spain and Italy are leading with strong earnings momentum, particularly, I would say, in banks and defense stocks, and valuations are still at compelling levels. Germany has been steadier. Their defense spending gains are likely already priced in, but we're still watching for potential rotation into cyclical and value sectors such as banks and autos. I think for us, the key to extending the rally will be earnings. We think that actually without further upgrades, valuation multiples alone offer limited upside, right? European equities have already benefited from the US dollar weakness, but in our opinion, sustaining momentum will likely require more follow through in profits and not just macro tailwinds. Finally, in terms of sector focus, again, banks, defense, healthcare look like stabilizers into the year end, while tech and autos may lag. Again, they're coming under pressure due to the new tariff regime with the United States. We think that the message for Europe overall is that, yes, it's attractive, but at the same time, investors need to be selective, leaning into Southern Europe and policy-supported sectors rather than broad-based exposures.
And for emerging markets, how we seeing things in that area?
The setup is very positive, in our opinion. They have had a long reputation for volatility, but we think that actually 2025 is showing a quiet shift, if you will. Earnings growth was flat for the latest quarter, but we noticed that actually the breadth of earnings revisions is improving for the first time in months, especially across Asia. The big driver here is technology, semiconductors, internet platforms, digital finance. They're all emerging as the new growth engines for emerging markets. So valuations are still cheap, momentum picking up as Fed cuts and easing of financial conditions, along with obviously weak US dollar, all tell us that actually an EM exposure can offer balanced portfolios dominated by the US mega caps. In terms of the deep down analysis on the sectors driving this performance, again, the clearest story in our opinion is semiconductors. There are some regional indices very strong in that area, such as Taiwan, such as Korea. They are powering ahead, really riding global demand for AI accelerators and high bandwidth memories. Internet shakeup is another thing that a sub-theme that we look out for emerging markets. China's big platforms like Alibaba, JD, Maotan are still grappling with competition in e-commerce and food delivery. But even there, I would say, for instance, Alibaba's cloud and international businesses are providing a buffer. There are other firms in Southeast Asia, such as Grab and Sea, that are, showing strong user growth and resilient profitability, and therefore remain attractive opportunities for some investors. So this highlights a key theme in our opinion. The digital economy is alive and well outside of China, and it's actually becoming a long-term structural growth story for emerging market investors. And finally, financials are regaining strength. Chinese banks are delivering profit rebounds. Again, Indian and Brazilian banks are also quite strong. They are reporting resilient loan growth and strong capital buffers. We think that global investors are still underweight EM banks, and therefore the sector offers both value and income at a time when developed markets peers are looking stretched.
Thank you, Lale. And emerging market lovers on YouTube, let us know what you like, the companies you've got your eye on, and it will be interesting to hear from you all. But we're not going to do this presentation, this webinar, this podcast about talking about crypto. So, Javi, how are you seeing things at the moment?
Yeah. Hi, Sam. Hi, everybody. I think that the traditional finance is embracing crypto, and that's key to understand who the winners are going to be. On-chain is going mainstream. IPO money for Figure and Gemini, plus the London Stock Exchange tokenized fund platform, show that capital markets are moving from pilots to real adoption. Expect faster settlement, lower fees, and more assets on-chain. Second point, I think, is regulation. Regulation is more clear now. The SEC said this week that most tokens are not securities, while European banks push stablecoins and the digital euro and tokenized markets. Different paths, same direction, more clarity. Third point to consider are stablecoins. We said that last quarter, because these are the real change in 2025. So stablecoins as payment rails, Google, MasterCard, no, use them in core system. So that's mainstream. It's not just crypto. And here we will see who will win this race. Ethereum, Solana, private blockchains. Last point, I think, is market maturity is growing. Last month, we saw big sales from old wallets, but Bitcoin prices are not crashing. They are going down, of course, but it's not a crash. I mean, it's $10,000 from the all-time highs. So mid-sized investors are still accumulating. ETF flows keep moving up. So that's a healthier market than in past cycles. So that means lower volatility. And that's why we said, Sam, that traditional finance is embracing crypto. And this is a key point for the future.
For sure. And actually, crypto right now across the board at the time of recording is at a really, really interesting level. When we move on to this slide, Xabi, what are you keeping an eye on? What is there to watch at the moment?
Yes, I mean that we have to check what capital markets are saying. Is Bitcoin becoming or not a digital gold? Ethereum could be the new market infra. So check what's going on with regulated stablecoins, with tokenized of stocks, fund, debt, and spec ETF, crypto market expanding. Expecting in October, Solana and Ripple ETF, but also ETF on basket of cryptos, ETF on altcoins. So at the end, check the market, check global liquidity, and if investors are in risk on, because there is a huge correlation with risk assets. Also, it's important to check what's going on with DAT, digital asset treasuries, because we have seen companies buying crypto for treasuries that are doing really bad. Premium in MicroStrategy is moving down. So here we have to have an eye on that. So be careful, because this is one of the points just to check for this quarter.
Thank you very much. And actually, I'm just going to have a quick look for those that are on YouTube at the moment, just about the chart. And I've purposely got Bitcoin here, and it's bang at a key level, which is what I mentioned earlier. You can see that previous all-time high that we had from May. We obviously ended up breaking through that in the summer. We're retesting it right now, and it's almost that level, that area that I see as a key line in the sand. Above that, we can continue to push higher into the back end of the year, is what investors will be thinking. Below that, things start to change, and we have a 200-day moving average below where we're trading that some traders and investors may well keep an eye on. If we do break this area of support, we're below the 50, we're below the 100-day moving average. So for some, that might be short to medium term bearish, but we're right at a key level now, one that I'd be looking at to see above bullish, below bearish, but of course keep an eye on those moving averages below, but also do remember to zoom out if things do come under a little bit of pressure. We've been on an incredible run over the last few years, and pullbacks aren't always the worst thing in the world. Now, Lale, back to you for our 2025 quarter four investment outlook.
Thank you, Sam. Look, our investment outlook is shaped by three key themes: diversification, sector rotation, and selective hedging. So we think that actually the macro backdrop is looking more supportive. Global growth is holding steady, inflation is easing, and interest rates are moving lower, especially in the United States. So that is actually typically a sweet spot for riskier assets such as equities, crypto, and commodities, while cash becomes less attractive. So going back to the first theme, diversification, right? So it's really about the benefits of diversification for this quarter. US growth stocks have been the biggest winners over the past few years, but we think that actually the valuations are stretched. At the same time, there are other areas that are beginning to catch up, right? So value stocks, small caps, as Brett has said, emerging markets, they all look better positioned, in our opinion, from lower rates and stronger breadth. Banks, industrials, consumer sectors are stepping up, thanks to, again, accommodative policy coming from the US especially, which is healthier for the markets, as opposed to, say, relying on the mega cap tech sector. Beyond equities, alternatives are regaining importance. As Javi said, crypto continues to see momentum, institutional adoption grows, while gold has been one of the year's top performing assets, acting as both an inflation hedge, but also a play on dollar weakness. So commodities overall, in our opinion, are going to continue to gain traction as supply chains are being reset and global energy needs evolve. In terms of key themes to watch, again, EVs, AI, and crypto, they're creating massive demand for electricity and alternative energy. That's driving investment into batteries, power grids, and even nuclear, right? So companies that are tied to this build out are becoming more critical players in the next wave of industrial growth. AI arms race is in our opinion, extended beyond mega cap stocks, software firms, semiconductor companies, and application layer businesses are now increasingly positioned to capture the long-term value as adoption spreads. Finally, the weakening US dollar continues to be a powerful tailwind, as it is going to help, again, emerging markets and international equities in the last quarter. So for asset allocation, we just want to talk about what it means for you. Again, on the positive side, we see opportunities in US value stocks, small caps, emerging markets, crypto, and commodities. In the more neutral camp, we place real estate investment trusts, European equities, which need further earnings upgrades to move higher, as I said before. And finally, we are cautious on cash, as they usually underperform in a lower rate environment compared to treasuries on the short end of the curve. So for everyday investors, this means that actually balancing portfolios more carefully instead of relying on US growth leaders, consider adding more exposure to value sectors, small caps, and international markets. Again, add diversifiers such as gold, commodities, or even an allocation to crypto that can help smooth out returns, right? And for those who prefer simplicity, broad ETFs or diversified smart portfolios, in our opinion, are an efficient way to implement this allocation. So overall, Sam, what we're saying is that the fourth quarter is about balance, lower inflation, falling rates, they're opening up opportunities, but it's really diversification across geographies, asset classes, and themes that will likely matter most going forward. Investors who broaden beyond US mega caps, lean into value and cyclicals, and maintain exposure to alternatives will be best positioned as we head toward 2026.
Amazing. Bring it on, I say. And for everyone listening at home or wherever you are, let us know your thoughts. What do you agree with? What you disagree with? We're always up for a discussion. That's what makes a market. Everyone, your work is not done just yet. We've got three or two questions each for all of you. You've got a minute to answer each one. There will be penalties if you go over that minute. Brett, we're going to come to you to start things off. Is, in your opinion, tech still a good investment as we look to quarter four and next year?
Yeah, Sam, I'll keep it under a minute. I can't afford to fall down the podium further. Yeah, when we looked at tech, if you guys recall back to the last quarter when we did this, we talked about how tech is really set up to do quite well for the remainder of this year. So at that point, it was the second half of the year, and it has done quite well through Q3. And a big part of that was tech was expected to have the best earnings growth of the 11 sectors in the S&P 500 this year, and it's one of the best growth expectations for 2026 as well. So if that remains intact, the group can continue to do well. But as we've seen rotation through sectors, we actually see rotation within tech too. And I think the Mag 7 does a really good job illustrating this, as we've seen some of the laggards in that group start to become the strong performers. The strong performers take a rest, and we see that rotation. So maybe consider looking for some rotation within the sector of tech.
Thank you. And perfectly under a minute as well. Xavi, this is a very common question people are asking at the moment. Will we get an alt season?
I mean, data said that annual season is likely, but first we need Bitcoin to finish the last big run, if any, of this cycle. For now, patience is key and what to watch. So Bitcoin dominance, if it rise again, all season gonna be delayed, if any. Ethereum versus Bitcoin, we need a rebound here first, and retail FOMO. All season usually means euphoric late stage retail inflows. So this is gonna be the key points just to check.
Thank you. And Lala, your first of two questions. Small caps have lagged for years. Brett mentioned this earlier, but why should, in your opinion, investors pay attention to them at the moment?
Sure. As Brett had said, valuations are at nearly whatever 2000 bargain levels. But in our opinion, more importantly, is the fact that for the first time in years, over half of small cap companies are seeing earnings upgrades, a bullish signal that we think has historically preceded sustained rallies. Fundamentally, though, we're saying that, look, financial conditions are also easing. Small caps rely heavily on short-term debt, and therefore any continued decrease in rates coming from the Fed will impact small caps more than large caps, and therefore might result in overperformance, right? Fiscal policy is another kicker. There's a upcoming 150 billion tax refund under the One Big Beautiful Bill, which will directly boost consumer-facing small caps in housing, retail, and discretionary. And add to that, again, improving fundamentals and under-owned positioning. We think that actually small caps offer a meaningful cyclical upside as we head into 2026.
Amazing. 3 questions to go, 3 months to go. It's all set up perfectly. Brett, your final question of this quarter. What other sectors might benefit from lower rates, in your opinion?
Well, we've kind of talked about the two staples of this conversation, at least of this quarter, small caps being a primary group to go to in a falling rate environment, tech being another, but really it kind of expands through the market. Something like the home builders tend to do well in a falling rate environment. Even dividend paying names can do well in falling rates. We kind of need a little help on treasury yields to come down as well to give them a bit of a boost. But in falling rates, it even extends beyond equities. You can see that be a positive catalyst for things like gold or things like crypto. So it really is a sort of fuels asset run in various different names, and equities would be a key place for me to look in that scenario.
Amazing. And Javi, your final question. Are we in a bit of a FOMO moment at the moment with all the buzz around Bitcoin treasuries?
Sure, there is a hype around Bitcoin treasuries and Ethereum and Solana. Yesterday, a fitness company quoting Nasdaq with real bad business model, with the stock price moving down from $500 to almost $6 in 1 year. They said that they want to create a Solana treasury with 100 millions instead of saving the company. So, I mean, some is pure FOMO, companies chasing headlines, but others are building real digital asset treasuries with custody, with rules and risk controls. So the key here, the key here is, are they buying Bitcoin or Solana or Ethereum just for PR? Or they try to build a strategy to create digital capital for longer? That's the key, Sam, to identify if one or the other.
Thank you very much. And Lale, our final question comes to you. Beyond equities, where should investors be looking in Q4?
I might be repeating myself here, but we are really clear that alternatives deserve more attention right now. So gold, as we know, is particularly standing out. It's trading at record highs in real terms and has really become a global liquidity reserve as investors are hedging against, say, inflation, de-dollarization, and fiscal deficit. So any consolidation in gold that we will see in the next quarter might be a buying opportunity, in our opinion. Crypto, again, also fits into this theme. While it's volatile, again, it's increasingly being treated as a legitimate portfolio diversifier, especially as institutional adoption accelerates. Commodities more broadly are showing signs of renewed strength too, again, helped by deglobalization theme and higher demand for industrial inputs like copper and aluminium. So I think the takeaway is that diversification today really means more than just mixing stocks and bonds, but alternatives such as commodities and even crypto are playing a much bigger role in how investors balance portfolios.
Amazing. And just like that, another 3 months is done. If you've made it this far, please do remember to like, share, subscribe, drop a comment. It does make a difference and we appreciate it all the same. But to Lale, to Brett and Xavi, thank you so much for joining. We'll see you in 3 months. Take care, everyone.